For 2 years, this market has had a tailwind like no other. AI. It's the engine behind the S&P's biggest winners, the reason hyperscalers are pouring billions into silicon, and the headline on every earnings call from big tech to biotech. But what happens when the leader of the AI arms race puts up record results and the stock drops? Tonight, we're talking about NVIDIA. The numbers, the whispers, the sell the news moment. We're also diving into the real state of AI deployment. That MIT headline claiming 95% of enterprise AI pilots are failing, and what the latest CapEx signals say about the road ahead. Welcome to The Money Runner. I'm David Nelson. Let's look at the numbers. Is revenue growth slowing? Of course it is. No company can maintain that pace, but valuations are coming in as well. Q2 revenue, $46.7 billion, up 56% year on year. Data center, $41.1 billion. And that was light, and in part why the stock is down tonight. Q3 guide, $54 billion. A bit above consensus. Gross margins, a stellar 73.5%. And analysts were looking for this. They were looking for gross margins to come up from the low 70% range up into the mid 70% range where they had been in the past. No China sales this past quarter. Now, the call is ongoing, so I'm going to have to dig into the transcript in the morning to see what they're saying about the next quarter. Translation, these numbers are strong. But the expectations were even stronger. This was the textbook definition of priced for perfection. The Wall Street Journal nailed it. When your stock is already carrying the market, even a beat can trigger a sell-off. The long-term path is to get to human intelligence. And while some tasks like language and vision are getting close, for others, it's years away. And that means continued spending. As long as engineers and companies see a path to human intelligence, you can bet the CapEx cycle will continue. And that's, of course, good news for most players in the food chain. The other big AI news in the last couple of weeks was an MIT report saying 95% of enterprise Gen AI pilots are failing to show ROI, return on investment. That's all over my feed and yours. AI is a bubble. I get at least 2 reports a day saying this. The reality, execution is the issue, not the models. MIT and Gartner both point to poor data, weak business cases, skill gaps, and budget overruns, not failed technology. Some analysts are pushing back, saying that 95% figure is overstated or misinterpreted, but it does reflect real growing concerns. Meanwhile, NVIDIA's demand comes from hyperscalers building out the infrastructure, and that's a separate gear, and it's still in drive. Let's ask the question directly. Is the AI build-out ending? Follow the money. Alphabet just raised 2025 CapEx to $85 billion, mostly for data centers. Meta now plans to spend $66 to $72 billion and even more next year. Microsoft is on track for a record quarterly CapEx spend of $30 billion. So is the AI trade over? I don't think so. CapEx is climbing, architectures are shipping, inference is getting cheaper. But yes, the street will demand proof. Those MIT headlines are a warning shot. If at some point it doesn't drive ROI, investors will cash out. And it's true in the long run, cycles like this usually end in tears. The AI trade is a little over 2 years in the making, and I still think there's a lot of runway ahead. If your thesis required every AI pilot to succeed, it wasn't a thesis, it was a fantasy. The durable signals are still there: CapEx, capacity, and customer commitment. And all three are rising. Full disclosure, I trade around my positions. Sure, I'm long NVIDIA and will come in long tomorrow, but don't think I won't trim or even eliminate it from time to time. That's risk management. All right, that's it for this week. Don't forget, if you want to learn more about yours truly or the Money Runner, go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is the Money Runner.